The first step in accurate pricing is to know your costs, your real costs. Really good contractors are those who know their costs.
A lot of people, when they do markup, just take their costs and double it. But a lot of times they don't really know what their costs are. And so they may think they doubled it, but in reality, they missed so many things that are off the mark and it just kills them.
Less stress, more time, more money. Welcome to the Cashflow Contractor Deep Dive.
Martin, we've got some restoration contractors in Oklahoma that are sitting on the edge of their seat, excited for all these storms popping up, ready for some insurance money.
Yeah. I think they'd hate to say it that way, but it's true. Yeah, we've had some towns that are going to be completely rebuilt.
Yeah, already. And we're recording this at the beginning of May. So usually May is the month.
And I have a tornado shelter being installed in my house this Saturday.
Is it underground?
So I've gone all these. No.
Is it your garage?
Yeah, it's a steel.
I have that already. Well, I haven't shot mine with the 30-30, but I have one in my garage above ground, and I deeply wish it was below ground because it takes up so much space.
I'm not worried about the space on it. We got that figured out. If you put it underground, for people not familiar, the way that's done most often here in Oklahoma is they put it in a driveway. I mean, in your garage.
In the garage, the floor of the garage.
Right. It's like you drive over it like you would drive over a oil change service pit. Has a sliding door. So
I've seen people use it as an oil change service pit, by the way.
Yeah. Well, it's perfect. But if you have an issue, sirens are going off. You got to move your car out of the garage into the hail, or perhaps you can slide underneath. The door slides, so the door will slide forward and back and open with the car parked over it. But you have to get in, and then you're underground. You have to notify the emergency services so that they come looking for you in this hole that's covered with debris. Anyway, but I guess you're still alive. So
one, the probability of you actually getting hit like that in that exact circumstance isn't high, but it takes up so much space, man. And I don't know, like I can fit both my cars in the garage, but not easy.
We literally have that worked out. It's not going to be a problem.
Well,
and I can tell you, it's going to have some stuff inside of it too. That's going to come flying out
storage
if we need to. Yeah, it's going to have some garage stuff in it.
There you go. Well, thinking about these restoration contractors and what's going on when the storms are coming, it's changed a little bit here in Oklahoma, but typically with the storm, the price is whatever the insurance company is willing to pay, we'll take it. Now they do create a bid, and it's gotten better. There's been some laws passed where they can't waive the deductible and stuff like that. But that's kind of their pricing strategy is we'll take all the money the insurance will give you to restore your home. And a lot of people go for it. But we're talking about pricing today, and not everything is priced exactly like that. Most things aren't, in fact. So with pricing jobs, two common strategies. This really stems from a conversation we had just the other day with a guest talking about how they think about pricing jobs, and we've got markup versus margin. So let's start with two definitions, Martin. What is markup? Let's start there.
Markup is an amount that you add to cost to come up with your price. So, and you can do it as a percent, you can do it as just a dollar amount. But to make it simple, if you have something that costs $100 and you add $10 to it, that's your markup.
Yeah.
Okay.
Yeah. So I think what are some common things that you see? I'll give some that I see, but with markup strategies, what do you see some contractors do in terms of using markup to price jobs?
Well, it's very confusing when you look at how people do it. We can talk about why that is, but basically they'll say 25%, right? So they just look at their cost and let's say you got $100,000, so they add 25,000 on top.
Mhm.
And then they do other things like add 10% more for office, right? Overhead, burden, and profit. And I really don't like using those descriptions of this is my markup for doing the job, this is my markup for profit, and this is my markup for overhead. If you're doing that, you just marked it up. Let's say you do 25, 10, and 10. You just marked it up 45%. I don't care what you call it, right? But it's kind of confusing because you wanders off into topics about burden and overhead costs that are getting allocated to jobs, which really kind of mess things up, really confuse things.
Yeah.
But the biggest problem with markup is people go around talking about, we'll have lots of conversations as we did with Tom Reber, where if you're new at the game, 50% margins. They go, okay, I got $100 cost. I'm going to add 50% to that as a markup. So that's $150 is my price. Well, that's okay, but your margin is $50. If your cost was 100 and you added 50, your margin is $50, and $50 is 33% of $150.
So you
So
really
your
had a
margin is
33% margin.
Yeah. And that's the big thing is people don't recognize that when they think about margins and paying their bills and good margins and healthy margins, they equate them with markup, and they're not the same thing.
Yeah. I think
A markup always results in a margin, right?
correct.
But the margin is always less than the
The
markup.
markup. Correct.
Yeah, always.
Correct. Simple math there. But important thing to know. And I think in terms of pricing and how people get to the markup stage, honestly, that's not really where most people start. If you think about a guy mowing lawns in high school, they're thinking in terms of hours. And that's a very common thing is they price based on hours. Oh, how long is it going to take me? I like getting paid $25 an hour or $30 an hour. And so I'll do this lawn for $30 because I can finish it in an hour, right? That's kind of the mindset is I'm thinking about my time. And so I price based on how long things will take, whether that's for me or for my employees. And that's valuable information to know, but that shouldn't determine what your price is. I think the next elevated mindset above that is trying to look at a way to price a job as high as you can, but to where you can have a really good profit margin. And a lot of people, when they do markup, like I've seen a lot of people just take their costs and double it. That's what they think. And that can be very effective. But they take all their costs, they just double it, and that's the price. But a lot of times they're not actually doing job costing, and they don't really know what their costs are. And so they may think they doubled it, but in reality, they missed so many things that are off the mark, and they're not thinking about overhead expenses as well. And it just kills them.
Well, that you're going exactly where I was going to go when you started on this. The first step in accurate pricing is to know your costs. Okay?
Yeah.
Now, when you're talking about how many hours is it going to take, there isn't a catalog you can go look at. You need to become good at estimating and controlling and paying attention and enforcing. That's a bad word, but enforcing the hours that you expect it to take so that you have a good idea of actual cost. The same is true for a lot of materials. You can go price rebar every time you have a concrete job. You can go price the concrete every time you're bidding a concrete job. You can go price lumber and all those things every time you do it. A lot of guys don't do that. They just go, I got a 30 by 60 foot, 4-inch slab. I'm used to charging about X $100 a square foot or square yard of surface, and they come up with a price. Well, they may be correct on their pricing and they may not, but I see that a lot. So what sometimes that does is people aren't looking at their costs. They're looking at what they consider be their cost for convenience. A lot of times that has some margin in it. Sometimes it's too low. Sometimes it's too high. So if you go out there and you have what you call cost is really kind of your estimated thing, which has some profit in it. and then you go and mark that up again or raise it by to achieve a certain margin, you're getting a margin on your cost and you're getting a margin on your margin, which is, I'm all for that. But sometimes you lose a job because of that and you don't know why. Whereas if you'd have gone and looked at your real costs and paid close, detailed attention to it and either marked it up or did what we have to do to make a margin, desired margin out of it, you have a lot more realistic understanding of what's going on in the marketplace.
Yeah. So, a couple things with this that I see people do is they look at materials and they include the labor in their pricing of the materials. So, example, let's say it's a landscaper, and so they may install plants and boulders and sod and mulch, all these things. They take the price that they get from their supply house or the plant shop or whatever it is, and they mark it up, and their markup includes what they want to charge for the labor. So whenever they give a price, they're giving the installed price to the customer. So that markup includes not only the materials, but it includes the labor to go and pick up the materials and then take them to the job site and then to install them and then to, service the job. Well, a lot of things need to be accounted for in that. And when you just say, hey, we're going to double it, we're going to do 100% markup, not everything is installed the exact same way. Like putting in a small bush is way different than getting a 1-ton boulder onto a property. Different pieces of equipment are needed, different amount of labor crew. And so that markup may actually be not even close. You're losing money with that 100% markup. So the job costing is extremely important there. And you're not going to be able to do the job costing accurately if you're not tracking detailed time to each job, if you're not tracking exactly what materials, what they were purchased, and what went into the delivery of those items to the job site. And then also the change orders aren't tracked very frequently. That's a huge one, as well as the revisions that happen. We messed up. We got to fix it. All that stuff will help you to better understand the job cost so that you can accurately mark up the work that you do.
Right. One thing we're kind of talking about, and I think what you're referring to, is a lot of guys do things by a rule of thumb, estimate this much. And if you've been in business for 40 years and you're making, 30% return to the bottom line, net profit, I'm sure not going to criticize your rules of thumb, right? They're working for you. You're probably dealing with a lot heavier margins, a lot higher margins than you might even realize. Maybe you do realize, but rules of thumb will work, but they have to be vetted. And what you talked about, if you don't include the labor to go pick things up, if you don't get your labor cost right and you lose money on the job, that's where job costing comes in. Job costing in books. I deal with innumerable people. We talk about how they bid and what their margins are. And usually when I'm looking at their cost sheet, we're not really looking at cost. We're looking at the rule of thumb for this and that. I'm going, okay, no, that's about what it costs us. We're not looking it up every time, the actual cost. Okay, well, what do you think you're getting? And let's even presume they have margins and markups right. Say, well, we think we're getting a 40% margin. Okay. So out of the price, 40% of it is left over after we pay all the variable costs. That's our money. Well, when you keep good books and you do what's called job costing, where you allocate the cost and the revenue to the job so that you know what came from that job and what went to that job, that's where the rubber meets the road. And you pull up your P&L at the end of the month. I literally have one. And we think we're in that 40% margin. Well, what's showing up in the books is 16%, right? It's going away. Well, that changes a lot of metrics. How much you have to sell to break even, the risk that you're undergoing, your potential profitability at the end of the year. And you need to know that, because if you think you're bidding at a 40% margin And it turns out when you look at your books, you're really getting 16. If you don't look at your books, you just be going, man, where's all my money going?
Yeah.
Right? I don't know. So if you don't know, what are you going to do about it? I don't know, because I don't know what the problem is. So
You know, a good
anyway, we're talking about. Go ahead.
a good like indicator. You said rule of thumb, and I like that. There's people that have really good judgment, and their rule of thumb works, and that's great. A lot of times they don't have the same head trash that some people have because they're willing to, hey, we're going to really price this one high. But that's not most people. And I think another thing that goes with that is some people understand that they shouldn't win every single job. And that's how they judge if they're pricing things accurately. They know that if my conversion rate on jobs is 100%, I'm not pricing well. And so that's another good rule of thumb sometimes is, man, you're probably not charging enough if you win every job you bid. And you really want to be losing a good percentage of the jobs because you can't do everything, one, right? But two, you're probably not profitable unless you are losing some jobs. And then you can focus on the jobs that are worth doing because they are profitable. So another thing to think about when you think about your pricing. So let's talk about margin a little bit more and the importance of margin. It's okay. You can still use markup specifically in different areas too. But let's talk more about margin. What is it and why does it matter?
Margin is the portion of the sale price that you get to keep after you pay your variable costs, which in contracting is usually subcontractors, labor, and materials. So it's the portion of the sales dollar that's yours. If you sell $100,000 worth of stuff and you have a 50% margin, you have $50,000 left over after you pay those bills I just mentioned. That $50,000 has to go to pay your overhead. And once your overhead's paid, to begin to accumulate as profit. If you don't make enough margin to pay all of your overhead, then you will lose money. And of course, we've talked about it before, but break even is the point where you've sold exactly enough to not make a profit or loss. Okay. So to give a simple explanation or method, discussion of that, we've done it before, but that would be calculating break even. If I sell $100,000, well, if I have a 50% margin, so 50%, 50 cents out of every dollar comes down to where I can use it to pay overhead or profit. If I have $100,000 a month overhead and a 50% margin, I have to sell $200,000 a month to break even. That makes sense?
Correct. Yes.
200,000 times 0.5 is 100,000 that pays my overhead.
Let's even just work backwards. I think sometimes that's a more better.
Well, let me give let me give one other example real quick.
Okay.
If I have a 25% margin, okay, going from 50% margin to 25, I have to sell 400,000 a month just to break even. That's the dramatic effect of margins. Make sense? 25% of 400,000 is 100,000, and that's what it takes to pay the overhead.
So let's work backwards a little bit. So let's just say that our overhead each month is $50,000. That is for our salaried employees that are doing accounting and HR, whatever it is. That's what we pay ourselves in salary. That's what we have in insurance and rent, debt payments, all that stuff. That is in our overhead, right? So we have $25,000, or I can't remember what I said. We'll just say it's $25,000 a month in overhead. Okay. Some people are like, man, I wish I had $25,000 a month in overhead. But
let's make it 100,000. The math is always really easy.
Okay. $100,000 a month in overhead, probably more realistic for most people. So that means that we know we need to break even. We need $100,000 of gross profit to break even. So that means that at the end of the day, after I do all the jobs and pay for all the materials on the job and the labor for the technicians that are on the job, I need $100,000. So if you work backwards and say, okay, so how am I going to get that 100,000? Well, if I have a gross profit margin of 50%, like you said, then I need to sell $200,000 worth of work and perform that work within a single month to be able to pay that overhead of $100,000 for that month. And if I let that month run over to 2 months, that $200,000 that I sold is now gone and I'm in the hole, right?
You're 100 in the hole,
$50,000
right?
or 100 in
I
the hole,
have,
sorry.
did we ever do intentional bidding on our podcast?
We probably did. Martin, this is we're almost at 5 years. Can you believe
Are
that?
you kidding me? No, I would have thought 2.
Yeah. So we've probably
5
done
years.
it at some point.
Well, I think we need to do, today's topic really is we're afield a little bit, the difference between a markup and a margin. And we need to make sure that we get that message out. But where you're going with this is where I love to go. It's intentional bidding. In other words, if you understand, as we talked a lot, business is not about sales. It's about making a net profit.
Yes.
And that subsequently converts to cash. So if you understand that, then you go out there and say, I need to generate this much gross profit to pay my overhead this month. In our example, 100,000. Well, we're not in business to break even.
Exactly.
By God. So let's say we got to make 150,000 because you started to say that debt is not part of your expense, but you have to make enough money to pay your debt every month. Right. So we start out with that. How much do I have to break even? How much do I have to service my debt? And how much do I have to generate what I'll call free cash flow? That's questionable whether that's really what the financial definition is, but free cash flow, profit above and beyond what I'm obliged to pay to my suppliers and my debtors, right? So you have to know how much that is. And let's say it was 100 to cover overhead, but all the rest of it, we got to have 150 a month. Okay. So if I got to have 150 a month, I got to sell 300 a month at a 50% margin. If I let my margins go down to 25%, I got to sell 600,000 a month. Can I do that? Do I have the people, the funds to finance accounts receivable, the insurance, the equipment, the machinery, the credit line with my suppliers to even do that? Well, I don't really know anybody who I've sat with. We sat down and consciously figured out their capacity and their needs. And what that does is if you don't have the guys to do 600, but you do to do 300,000 in sales, and you've got to pay your bills and make that extra amount of profit, then you say, I have to have a 50% margin. That is bidding with intent.
Yes.
And that is when you go to the job, you go, I'm not going to take 10% off the whole price, which is, depending on where you were, that's 20% off your margin because you're half, right? I'm not going to do it. And he said, well, you can't get the bids well, maybe that's true. You can't get the bids if it's a construction project for the state, right? But there are ways to get, if you're selling to the public, there are things public will pay you for. But anyway, if you can't get it, okay, then quit business because you're just going to go broke. And you're going to go broke owing a whole lot of money instead of just quitting now and maybe owing on the credit card, right?
Yeah.
And I'm not suggesting go broke. I'm suggesting the opposite. Know what you have to do and go do that.
Yeah. And if you can't price, if you're like, man, I'm literally cannot win a single job at that price, that's where you need to start rethinking your overhead as well. That's where, I'm employing my best friend's son but he doesn't really work that hard or whatever. Got to go. That's causing you to lose jobs. I mean, your problems just become so much more clear and the solutions become so much more clear when you know these numbers and you know that margin.
Yeah, I love the word have to. This is what I have to do.
Mm-hmm.
Because nobody wants to lay somebody off. It's so incredibly hard. Here we are on overhead. We were talking about margins and markup, but it is so incredibly hard to cut overhead.
It's so hard.
I don't know why that is. I mean, I say myself, my wife's business, we work on all the time. But with all my clients, we're looking at overhead. People costs, well, they've been here a long time. They got a family. And what do they do? well, I've always had this machine or this. Maybe I got a $2,000 damn copier in my office that I gotta have. Oh, it's costing me.
Yeah.
I've seen it. 2,000. Well, that's not even remarkable for some of our listeners, but small companies paying 2,000 a month for a copier lease. No, but it's easy to not ever get it in the first place. It's just really, really hard.
Well, I mean, if you think
It
of business as a person, the changing overhead is a lot like behavior change. It's a lot like lifestyle change. And that's why it's so hard, because subjectively, we can always find a reason not to go to the gym. We can always find a reason why, oh, I can't cook tonight, and we can just order the pizza. And we can always find the reason for having a few extra drinks because of this event or celebration that we're going to, whatever it is. And to change that behavior, to change that lifestyle requires intent. You have to be very clear about where you're trying to go and the reason why you need to make that decision. And then you need to go forward. I mean, that's what an overhead, if you're going to let somebody go to lower your overhead, you've got to be very clear and objective for the reason about where you're going and why this needs to happen. And it's that have to, right? If you can put your position of the have tos in life and personal life, as well as in your business, you'll make better decisions, right? So
Yeah, and we'll just say it in passing here. The way to handle overhead is not to have it in the first place. Yeah, I don't remember where I read
exactly.
it. I don't know whose philosophy this is. Somebody else came up with. But if you know you need something, you know you need it. Wait a month.
Yep.
And if you still know you need it, wait another month. And if after about 6 months, you can really put a pencil down and say, if I'd had that skid steer, I could have done that job in half the time, which would have enabled me to do another job. Anyway, you can really point to it, and you've waited a long time. A lot of times you'll wind up never buying anything. I don't need it. We're doing fine. Other times you'll find places where it really is an efficiency difference maker, and you do go and buy it. But it's easier to not get it in the first place than it is to get rid of it. So
well,
I think we need to jump back in.
We will. I want to make a point with that
Okay.
because I think this is important. Delayed gratification is really what we're talking about in some respect.
Yeah.
And I think with that, it's a long-term approach when you're willing to delay gratification and take on the burden now rather than later, then you really succeed in the long run. What I mean by that burden is you have burdens in life across the board. Maybe it's really hard right now to do those jobs without the skid steer, and it's grueling. We're struggling capacity wise. We're really hitting our capacity every single week, and it's a push through. But you would have, if you bought that skid steer now and you couldn't afford it, or you got comfortable with it and you weren't really ready for it, the burden you're going to have because of doing that, if not delaying the gratification, of not just pushing through right now, is going to be losing money. It's going to be having to service debt. It's going to have to be the stress of having to afford the machine, even though you weren't ready for it. And so you've got to understand that you've got to pay a price at some point. Why not pay the price right now of just pushing through rather than maybe giving yourself a really hard burden down the road? So I'll get off the soapbox. Let's talk back to markup and margin. So when we talk about markup and margin, we understand why we need margin, the benefits of helping us to make clear decisions, to really see exactly what we're going to make and how it applies to our profitability as a whole. What does it look like in the ideal scenario for a contractor when they are bidding with margin? What does it look like each and every day when they go to price a job?
Let me make one point before I attempt to answer that. Is you can use margin to find break even, the way we were talking about earlier, by dividing your overhead by the margin. Okay, so if you have $100,000 and you divide it by 0.5, 50 cents, or 50%, it tells you how much you have to sell to generate that margin. That if you take 100,000 and divide it by 50%, the answer is 200,000.
Right.
So that tells you you're break even. You cannot do that with your markup, right?
Correct.
Because a 50% markup gives you a 33% margin,
Right.
right? $100, we're going to add 50 cents to it. 50 cents is a third of $1.50. So that's one reason you have to get the margin.
Mhm.
You can have a big enough markup that it's just as good as a margin, but you can't do the math with it. You have to get the margin. So now your question was, what does it look like on a day-to-day basis if you bid
Yeah, when you're
correctly?
pricing jobs, and you're looking through material costs and labor costs, and you've got this big project to bid, how does it look on an ideal scale to use margin rather than markup?
Well, the way I do it, and the way I encourage people to do it, begins with what I said earlier: know your costs
Mm.
and your real costs. Matter of fact, one way, don't remember who it was, somebody I highly respect, was saying that really good contractors are those who know their costs. That's their first attribute. They really know their costs. The really big guys, the really, really big guys working across states and 1,000 employees, you better damn believe they know their costs. And they kind of screw things up too. But it starts with know your costs. And then you don't have to, when you're adding margin to something, you alluded to it earlier, people mark up their labor, right, with a markup, and then they go over and they get their costs for their materials and they just throw it in, or they mark that up a little bit. Like maybe they double their labor and 10% on their concrete, on the
Yeah,
cement they're using. I don't care.
that's not what I'm
That's a
looking at.
mental that's a mental model that somebody uses, which is fine. That everybody has their way of thinking of things. I say aggregate your total costs, estimate your labor, how many hours and how much does labor cost? And by the way, if you're paying $25 an hour plus $5 worth of benefits, your labor's $30. Okay. That's fair enough.
That's the other thing I was going to
An
mention.
hour.
There's so many things that aren't included inside of labor
Oh,
costs.
well, you are exactly right, but get those right. They're the real or write a check form labor cost. What you pay the guy, his benefits, you can even divide it by some number and kind of gross it up to cover his vacation pay. But
And
you get
maybe
an
his
hourly
workman's
cost.
comp. I know
Oh
that's an
yeah,
overhead
yeah,
expense, but just think about those things, right?
yeah. Well, if you can attach them to an hour, go ahead and do that and get a real labor cost. What I see a lot of times is people go, well, I got to add I've got a story in my book of a manufacturing company that I asked them what their labor cost was, and they said $80 an hour. And I'm just going, in a small town in Western Oklahoma, Western Texas, go, no way, you know? Well, when we got to the real, how much they wrote guys, it was like $25. It's been a while, including their workers' comp, including their vacation
Yeah.
pay. It's $25. I said, where'd you get this $80? They said, well, we got to have something to cover overhead. So they called $80 their cost, right? It's not. Good bidding, in my mind, always begins with an accurate understanding of your cost. You can know the labor hours. You're going to have to get good at estimating. The labor cost per hour. You have to just get good at estimating how long it's going to take people.
Mhm.
That's part of the skill of becoming better and better. So you multiply those two together, then you get the real cost of the materials and the things you're going to use. And that's your real cost. And then you you gross that up by the margin to
Mhm.
get your bid price. That will give you a margin, right?
Yeah. No, that's good. And I think I like that you said the know your cost aspect, and maybe people think they know their costs, but they haven't gone into the detailed aspect of every little thing that goes into the cost for a job.
Well, we've got people listening, and I'm going to go ahead and confuse it a little bit, but they'll be thinking, oh, that skid steer, right? I bought that skid steer and I'm using it on that job, and I got to charge that job $100 an hour for that skid steer. Okay.
Mhm.
Okay. Why not 200? I don't know. Okay. I'll do two. No, how about 50? Right. Skid steer costs you what the skid steer costs. And generally, barring maintenance, you're going to have to pay for that skid steer whether you're using it or not,
Exactly.
right? So the overhead of owning a skid steer, I say, well, I want to charge them $500 for using the skid steer for 2 days. I don't care. Go ahead, do that. That's just another way to raise your price.
Yeah.
Right?
For you to justify it.
But you can get really, really complicated in trying to do things like allocate your billing clerk part of his or her time. Well, they spend time, figuring out, calculating the monthly bills that we're invoicing. Oh, okay. But all of a sudden now you're just into this horrendous mess of, well, how much of the billing clerk's time went to this job and how much went to that job. And now you've got to hire 2 new accountants to keep track of all your assumptions. I'm just going, take the direct real costs, the labor times the cost per labor, the materials, any other things, fuel that gets you, tangible things that you actually write checks for and call that your cost. The rest, I tend to leave it in overhead.
Yeah.
I know there's some people listening that their heads are exploding because they'll yell at me all week about, got to allocate for profit. You got to allocate for burden, which is an allocation of a portion of overhead to the cob. I go, okay, but that's arbitrary. How much you want to allocate? It's meaningless. Keep them separate. Make it simple.
Well, I think
so. The real quick answer too on this might be hard to follow on a podcast as opposed to sitting here with a pencil. But if you're going to use a markup, you take your cost and you multiply it times your markup. So $1, and you want a 50% markup, multiply, add that to it, $1.50. To find your margin, you take your cost as you calculated, $100,000 of cost, and you divide it by 1 minus your desired margin. Yep. That's where it gets hard. So if you want to,
it's not that bad.
If you want a 40% margin, and you have a $100,000 job, you take 1 and subtract 40, which makes 60%, and you take your 100,000 and divide it by 0.666, and you get $1.50.
There you go.
150,000. You now have your margin. That's just the way the math works out, which I think is one reason that some people don't use margins.
Well, it's just a formula and adding it to it, but it's typically, I think where it goes wrong is, like you said, knowing your costs. The measurement of the cost is not accurate. So
that's the number one thing.
Yeah. Well, we've discussed markup and margin and a lot of ancillary things to it. But I think at the end of the day, it's okay to use a markup, but you have to know your margin. The margin is the one that matters. It allows you to determine your break even, to know your profitability, and lots of different advice that we have throughout here. So hopefully this is a valuable episode to people, just a conversation around it. Something else you want to say, Martin?
Yeah, I'm going to say that if you want to take something really easy away from here, just double everything. Okay? Know your accurate costs, labor and materials, and then double it, and you'll have a 50% margin.
There you go.
And that probably will work for you.
Probably will work, but make sure you're doubling everything, not just some of the things.
Yeah.
Because that's where you run into issues. Is like, well, I doubled it, but you didn't account for.
Yeah, that's one thing Tom Reber says. He said, just double everything. That's easy to understand. You don't have to follow Martin's babbling about markup and margin. Just double everything. But he also says when you get really good and really sophisticated, you can start bidding with nuance. In other words, I'm going to bid this one with a 35% margin because it's close to me and I've got accurate costs and we might be able to work some savings out. But I know I'm going to get 35. New guys double everything. So they get shooting for that 50%. They'll be lucky to get 25. That's just the way because of misbidding. That's just the way it works out. We've all gone through that.
Absolutely. Well, hopefully this is a valuable episode. Please go subscribe to us on YouTube specifically. We've seen a lot of great traction there. Good to see. all the views and comments we're getting. So please go on YouTube, subscribe us, share the channel with a friend. And thanks for listening to the Cashflow Contractor. See you, Martin.
See you, man.
Thanks for listening to the Cashflow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.